Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar. Okay, I'd previously spoken about how the most recent significant move lower was spotted some 5 weeks ago by combined support between 1630 and 1681. This halt opened the way for a variety of bullish actions, such as an immediate capturing key reversal up, and also a bullish engulfing pattern. But as I said at the time, this reactionary move up lacked depth, and we had another key reversal down soon after. Yet, as I said 3 weeks ago, and I quote, I'm not too hopeful for any significant follow-through lower. After all, we are so close to that support band, 1630 to 1681, that you may only have a small move lower after all that, end of quote. And I was right. We soon after had bullish moves higher and risen far further than initially I'd anticipated. Anyway, to cut a long story short, I suspected a move up to the 50% 21st century absolute Fibonacci line at 1809. Yet I also added 4 weeks ago, and I quote, that is, until it changes course one day, the market's going to make a break one way or another. For the moment, the recent head and shoulders is dormant, and the middle time, currently 1757, of the ever so mildly bullish December 2020 to March 2021 shift pitch fall, is just showing a gentle direction higher despite the key reversals down, end of quote. Okay, so 3 weeks ago the market made a marked move up over the key 21st century 50% absolute Fibonacci line. I said at the time that, and I quote, the difference from this time from late June, early July action is that we already had a close over the 1809 level last Friday. If prices do so again consecutively, then the 2021 high 1894 will be in the frame, end of quote. And it was. However, the market this time had the ammunition to try higher, especially 2 weeks ago when we had 2 daily key reversals that ended that week and ended the week as a weekly key reversal up, something I highlighted in my Chicago commentary last week. So we had the bullish incentive organized, and it was last week that we saw prices really take off. Prices not only pushed up and closed over the 1894 level, but Friday, as the market pierced and closed over the significant upper time, currently 1982, of the previously mentioned ever so mildly bullish December 2020 to March 2021 shift pitch. So where now? Well, we won't have to wait long to find out, as prices are moving up to a congestion area from January to February overhead, January to February 2018, between 2010 and 21 even. Will the current bullish incentive be enough on the upside? Probably, as there is a lot of ammunition below, built up definitely below. Only consecutive closes below the 1894 level would raise a question mark. Ice Europe white sugar. The interesting February to May shallowly bearish shift pitch will continue to give the bearish angle of attack here until it didn't late last week. Prior to that, the week before the break higher, the market had indicated it was summing up energy for an attempt higher, with a weekly key reversal up, this after the previous week's outside week as well. Thus the market constructed the move higher, which was celebrated last Friday, but closed up over the previous high for 2021 back in February of 490.10. This was also within spitting distance of target X in the 495 even area, the target for the June to July smaller double bottom after so many missed opportunities. I said at the time, and I quote, this is a big ask as it is beyond the upper time and the current high for the 2021. However, it all depends if, and it is a big if prices can clear on the upside the double bottom neckline at the lesser Fibonacci level at 460.5 by a sufficient margin and have consecutive closes over it as well, something that so far we've not seen. Well, they did, and we are here now, today, fulfilling target X on the upside. So what now? Well, there are two big bullish scenarios on the upside that I'd like to discuss. The first is to look at December 2020 to date action as a possible bull flag, with maybe target X1 in the 510 area. The second is even larger. To look at the whole September 2020 today action as also a huge bull flag. That gives a potential topside target X2 in the 560 area. These are, as you can gather, big asks of the market, but then so was 510 originally. In the way up there, should the market try for them, is the congestion from early 2017 between 513 and 518 even. And then there's the gap, 531.70 to 532.70 from March 2017. That is just to name a few. This will require further pondering, but the market does still have the ammunition below to achieve this. White premium spread. A very clear pattern 5 weeks ago here. A weekly key reversal up based on the middle time, currently 42.75. The big bearish May 2020 to February 2021 Andrews pitchfork. This pitchfork has been showing the bearish angle of attack of this market since February. As I said some 7 weeks ago, please note this is a declining support, as is appropriate for a bearish pitchfork, so please do not think of it as any form of counter to the overall bearish incentive that is currently evident here. This is, as I pointed out 2 weeks ago, which is actually 9 weeks ago now. Until we see the market move out of its strictures, then this bearish pitchfork will prevail. End of quote. So, last week saw a strong dip all the way down to the middle time. However, that was not all. You see, we had also a strong pullback up, enough that two potential bullish patterns emerged. Hammer pattern, and oddly enough, a bullish engulfing pattern. This is by no means the end of the bearish Andrews pitchfork, but is interesting nevertheless. This week we've had a suitable follow-on high already to the previous week's action. What looks right now like a bullish opening white Mariposa. It has, however, halted at the first overhead resistance. The dive bombing short stroke medium moving average currently up 56.25. Now, before we all get carried away, let me inject a note of caution here. The first significant overhead resistance of note, the one that I have mentioned consistently, is the neckline of the February to November 2020 failed head and shoulders top, currently at 75 even. However, because of the big move down last week, it now has a partner. And that's the 50% Fibonacci line of the whole of the 2021 action so far, at 73.75. Plus also the medium moving average, currently 74.5, is now streaking through those levels. All this is before we even catch sight of the descending upper time, currently at 77.5. So please remember something I've said again and again, especially in any rally, is after all a bearish pitchfork, and until it is broken or replaced, it will drive the bearish incentive. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.